The financial statement is a fundamental accounting tool for any business. It provides a clear and concise snapshot of a company's economic, financial, and equity situation. This document is prepared at the end of a specific accounting period, usually the calendar year. Its primary function is to provide essential information to a broad range of stakeholders, including investors, creditors, employees, customers, and tax authorities. Financial statements allow for the evaluation of past performance and the formulation of future projections. Through its analysis, it is possible to understand the company's ability to generate profit. Its capital strength and liquidity are also assessed. It is a key indicator of financial health and operational sustainability. The financial statement is therefore much more than a mere collection of numbers. It is a quantitative narrative of the company's business. It reflects the strategic choices and management efficiency adopted during the reporting period. The preparation of financial statements is a process strictly regulated by specific regulations. These laws and accounting principles ensure that the information presented is reliable, transparent, and comparable. Regulatory compliance is crucial to the legal validity and reliability of the document. In Italy, the main regulatory references are the Civil Code, which establishes the structure and minimum content. Added to these are the National Accounting Principles issued by the Italian Accounting Organization, OIC. They provide detailed guidelines for the correct application of the rules. For listed or large companies, international accounting standards, IAS and IFRS, are also relevant. These standards are International Accounting Standards, IAS, and International Financial Reporting Standards, IFRS. They aim to standardize financial reporting globally. A thorough understanding of these regulations is essential for accountants, entrepreneurs, and analysts. It allows them to correctly interpret data and make informed decisions. It is the foundation for informed and responsible business management. The Italian Civil Code precisely defines the structure and content of financial statements. This regulation ensures uniformity and clarity in the presentation of financial information. Compliance with it is mandatory for most businesses. The financial statement is primarily composed of two key sections and a complementary document. These sections are the balance sheet and the income statement. The notes complete the information. The balance sheet illustrates the company's financial position at a given point in time. It is a static snapshot of resources and uses. It is drawn up as of the closing date of the financial year. The main components of the balance sheet are assets and liabilities. Assets represent the company's assets. They are resources controlled by the company, capable of generating future economic benefits. Examples of assets include property, plant and equipment, accounts receivable, and cash equivalents. Inventories and financial securities also fall into this category. They are classified based on their liquidity. Liabilities, on the other hand, represent what the company owes to third parties. They are present obligations arising from past events. Their settlement is expected to result in an outflow of resources. Liabilities include trade payables, bank debts, and employee debts. Tax liabilities and provisions for risks and charges are also included. They are classified based on their collectability. The difference between total assets and total liabilities represents the company's net worth. This value indicates the company's net worth. It is the portion of the capital owned by the shareholders or owners. Net worth consists of share capital, reserves, and operating profit or loss. It reflects the company's self financing and is a key indicator of its financial strength. The income statement summarizes the revenues and expenses incurred by the company during the financial year. Unlike the balance sheet, it offers a dynamic view of management. It measures economic performance over a period. The income statement determines the financial result of the financial year. This can be a profit, meaning a profit, or a loss. A profit indicates that revenues exceed expenses. Revenues are primarily derived from the sale of goods or the provision of services. They represent the value of the company's transactions and are the driving force behind its operations. Costs include raw materials, personnel costs, and depreciation of capital goods. They also include financial expenses and taxes. They are incurred to generate revenue. Analyzing the income statement allows you to evaluate operational efficiency. It helps you identify the most significant cost areas. It offers insights for optimizing management and improving profitability. Accounting principles play a crucial role in preparing financial statements. They provide detailed guidelines for the measurement and presentation of financial statement items. Their application ensures consistency and accuracy. The primary objective of these principles is to ensure the transparency, reliability, and comparability of financial statements. Without them, financial information would be difficult to interpret. Their adoption is essential for investor confidence. The National Accounting Principles, issued by the Italian Accounting Organization (OIC), are known as OIC. They complement the provisions of the Civil Code and provide specific guidance on how to account for various business transactions. An example of applying OICs is the valuation of inventory. Companies can choose between different methods, such as FIFO, LIFO, or weighted average cost. The choice affects the value of inventory and the cost of goods sold. Another significant case is the accounting for depreciation of capital goods. The Italian accounting standards OICs establish the criteria for determining the useful life and residual value. This impacts the annual cost and carrying amount of the assets. The recognition of receivables and payables is also governed by the Italian accounting standards OIC. They require valuation at amortized cost or estimated realizable value. This ensures that the values recorded are realistic and prudent. International accounting standards, IAS IFRS, are adopted by listed companies and other large corporations. They offer a more flexible and fair value oriented accounting framework. They aim for greater global harmonization. These principles are often more complex and require in depth interpretation. They emphasize the economic substance of transactions. This can lead to different representations than OICs. A prime example is IFRS 16, which governs the accounting for leases. Before IFRS 16, many operating leases were not disclosed on the balance sheet. This distorted the perception of debt. IFRS 16 had a significant impact on the balance sheet and income statement. It required the capitalization of nearly all lease contracts. This increased assets and liabilities, changing financial ratios. The application of accounting principles is evident in numerous real world cases. Consider the valuation of a financial investment. IAS, IFRS often require fair value measurement with direct impacts on the income statement. Another example is the accounting for a provision for risks. The Italian accounting standards, OIC, and IAS IFRS establish precise criteria for recognizing contingent liabilities. This ensures that the financial statements adequately reflect future uncertainties. Determining the value of a brand or other intangible assets is another challenge. Accounting principles guide the recognition of these assets. They establish the conditions for capitalization and amortization. These examples demonstrate how accounting principles are more than just abstract rules. They concretely influence the representation of business reality. Their correct application is essential for truthful and accurate financial statements. In addition to the balance sheet and income statement, the financial statements include additional documents. These provide additional and detailed information and are essential for a complete understanding of the company's financial position. The notes to the financial statements are one of these key documents. They provide detailed and complementary information to the financial statement items. Their purpose is to clarify and expand on the presented figures. In the notes to the financial statements, the company explains its accounting policies. Valuation methodologies and depreciation criteria are illustrated. This allows users to understand the basics of reporting. Significant changes in balance sheet items are also highlighted, explaining the reasons for these changes. This provides a dynamic view of the financial performance. The notes also describe related party transactions. These transactions can impact the financial position. Their transparency is crucial to avoid conflicts of interest. Information is provided on events occurring after the end of the financial year. Commitments and guarantees provided are also illustrated. The notes to the financial statements are a veritable glossary of financial statement terms. The management report is another highly important complementary document. It is prepared by the company's board of directors. It offers a narrative perspective on the company's performance. This report analyzes management performance during the financial year. It describes the results achieved and the main operations carried out. It provides qualitative context to the numerical data. The management report identifies and assesses the risks and opportunities faced by the company. It illustrates the strategies adopted to mitigate or exploit them. This provides a forward looking perspective. The company's future prospects are presented, development plans and strategic objectives are outlined. This helps stakeholders assess long term sustainability. The report also includes information on research and development, the environment, and personnel. It offers a holistic view of the company and is a key tool for communicating with the market. In short, the notes to the financial statements and the management report are essential. They transform the financial statements from a collection of numbers to a comprehensive and understandable narrative. Their analysis is essential for a thorough assessment.